No Islamic economics. Islamic economy is an economic system based on Islamic principles. These principles are mainly derived from the Quran and Sunnah, as well as the views of Islamic scholars and intellectuals. Islamic economy emphasizes the principles of justice, balance and blessings in economic transactions. In Islamic economy, there are several fundamental economic principles, including 1. Joint ownership, Musharakah and profit and law sharing, contract Mudharabah, to fair trade. 3. Prohibition of interest, or usually Riba, for prohibition of speculation Maisir. 5. Prohibition of fraud and market manipulation. There are in addition, Islamic economy emphasizes the importance of zakat, or charity, as a means to strength and the distribution of wealth equally, as well as playing an important role for Islamic financial institutions, such as Islamic banks and Islamic insurance. In practice, Islamic economy has been implemented in various countries in the world, especially in countries with a majority Muslim population. However, the implementation of Islamic economy remains a controversial topic among economists and academics, particularly in terms of its effectiveness in addressing modern economic challenges. Here's an example of how Islamic finance works. Let's say a person wants to buy a house, but does not have enough money to pay for it in full. In a traditional mortgage, the person would borrow money from a bank and pay interest on the loan. However, in Islamic finance, interest is prohibited, so a different approach is used. In Islamic finance, a common financing method for buying a house is called Musharakah. In this arrangement, the bank and the buyer enter into a partnership agreement to purchase the house together. The bank provides a portion of the funds for the purchase, while the buyer provides the remaining amount of the house is then shared between the bank and the buyer, with the bank owning a portion of the house that corresponds to its investment. The buyer then agrees to buy the bank's share of the house over time, making regular payments that consist of both the principal and a portion of the rental payment for the use of the bank's portion of the house. These payments are based on a pre-agreed schedule and are structured in such a way that the bank gradually sells its share of the house to the buyer until the buyer becomes the sole owner of the house. This financing method is compliant with Islamic principles because it involves a partnership between the bank and the buyer, where both parties share the risks and rewards of the investment. It also avoids the use of interest, which is considered exploitative and unfair in Islamic finance.